The following program is made possible in part by the Dayton Bar Association.
Good evening and welcome to You and the Law. I'm Mike Monta, your producer and host for tonight's program. We're in March of 2018 and we're going to be talking about something that's going to be coming up for almost all of us within the next month and a half, and that's taxes. Taxes are changing, taxes are subject to fraud, and taxes are grueling. So we're going to talk all about that today. Joining me as an expert as he has for a number of years. One of our local experts in this field is Mr. Chris Cowan, and we will talk to him in a moment. First of all, we're going to let you know that You and the Law is a monthly presentation here at the DATV, which is on Channel 5 and Spectrum. Used to be Time Warner. It's cable cast on tape delay north and south of town. If you're in the suburbs, you are getting this on Channel 6. Executive producer for our show is former domestic relations judge Mike Brigner. We come to you at datv.org, and we also stream. That's what we stream on. So if you've got your computer, you can watch us on that. We're an audience participation program. We're coming to you live and in color, and there will be a number on your screen, which is 223-531. That'll show up periodically, and that is the number for you to call in and ask Chris questions about taxes and anything related to that. So we are sponsored by the Dayton Bar Association, as you saw at the top of the show, and we'll be talking a bit about them and their services as the show goes on. So without further ado, we're going to turn to our guest, Mr. Chris Cowan, and he's going to tell you a little bit about himself and familiarity with the topic.
Mike?
Chris, good evening.
Mike, thanks for having me. It's been a lot of fun over the years. As you know, Mike, I'm a retooled accountant. I was in the public accounting arena for a handful of years, and then went back to school at UD and got out of UD Law School in '81. And Mike, since then I've been practicing in the tax, commercial, finance, planning, estate planning arenas ever since.
Okay. Well, there's been a lot of talk in the past 6-8 months about taxes, tax plans, what's going to happen, how's it going to affect everybody. What do you see right now as happening, first of all, for 2017, and then coming into what they call the tax reform plan? And it has changed a bit, and it's been discussed a lot. So where are we right now?
Where are we? I think we can divide it, Mike, into 2 years fairly cleanly. The good news with folks doing their 17 income tax returns is they're virtually a mirror image of what happened in 16. We have some indexing for some deductions and for exemption amounts. There are virtually no significant changes in the 17 tax preparation compared to 16.
That's the one we're going to be doing right now up through April 15th, unless we get extensions, but
right.
That's the target date, so that the forms will be pretty much the same, the rates will be pretty much the same as it was last year.
There are really no significant changes in it that are going to affect the average person doing their taxes, whether they're doing them themselves with TurboTax. Everything would look virtually identical to what they did 16, and if they've taken their documents or are going to be taking their tax records to a preparer, the same things that were the roadmap for 15, 14, 16 years will be the same sort of data. There's going to be no significant changes for 17.
Okay, so let's talk about what's going to happen for next year, and there was a lot of discussion about the tax plan, which was passed by a slim margin back in December and signed by the present president, Mr. Trump, shortly after that, promising big changes in benefits. So what are some of the primary things you think are good or maybe not so good?
Well, maybe, Mike, we can just sort of tick and trace through some things, and I have a little outline here. We can work maybe together. And maybe we start with some good news.
Okay.
Good news. Virtually everyone will get a little decrease in tax rate. These are not significant decreases, but if you look, and we've gone to we have 7 brackets of different tax rates, the highest being 37. So whether you're at the 22, the 25, the 35, whatever, you will find that if you were in, say, the 25 last year, you might be part in 22 this year. Now, these are very modest, truthfully. We're talking just a percentage or so different. There are a couple spots where it's going to be the same depending on your filing status and depending on your income level. But all things being equal, almost all taxpayers in 18 will have a little better break, if you will, on the tax bracket piece.
Now, when they were talking about passing this last year, they said, well, we're going to really simplify this by making 4 brackets, and I don't know how that would have simplified anything, but we kept the same 7. Is that good, bad, or?
I think it would have been, I don't know if the brackets mean so much as
nobody else did either.
Or whether it's the amount of the bracket, right?
Okay.
So that didn't happen. I cannot tell you what sort of maneuverings transpired where the 4 that was wished for turned out to be 7. We end up with 7. The only good news I can pull out of this, and I think it's pretty universal, is most people are going to have a little better break in the tax bracket.
Okay.
Generally speaking.
Let me ask you this. For 8 years, the party that's in power now was not in power then, and complained that we should balance the budget, and we shouldn't be wasting our money, whatever. And it seems like, tell me if I'm wrong, that the new tax plan is going to greatly add to the deficit by not getting as much taxes from its citizens as before. So how do we square that, or can we square that?
Don't know. The stuff I've read, I read a little article in Goldman Sachs recently. They think the Tax Act initially is going to be an economic boost. These are small percentages, between 0.5% and 1% the first year or so. There are so many intangibles in this that I don't know if we really know. I am not an expert in corporate tax or overseas earnings by corporations doing business in the U.S., domiciled in the U.S., having off-sea operations. But there has been significant dollars come into the U.S., billions of dollars by Apple and other big companies. How that plays out, Mike, long term, I really don't know. But there's nothing in this bill that's been designed to address the deficit from anything I've read, because we can tick and trace through some of these changes, and you'll see there'll be some changes where there'll be some things like the brackets that are pro-taxpayer, and you'll see some other things that are going to be not so beneficial to taxpayers that may raise some revenue. But I don't think anybody is saying that this particular tax bill is aimed at or is an attempt to address deficit spending or the debt. No one's talking about that, because for us to attempt to put a dent in the debt, all these brackets would have to go up. All the deductions would have to go out. There would have to be enormous tax revenues to generate any kind of revenue stream to attack the debt, because we're not having enough generated revenue to pay the deficit. So there's no attempt in here to handle those sort of issues.
Well, I think just general math is if you reduce taxes, you reduce income that's coming into the government. Can we agree on that?
Don't know. It depends on what people do. It's how they spend the money, and do they spend the money for things that make businesses and are better spenders than the government? I don't know. That's sort of an economist type thing. I don't have the answer. I think the wishful thinking is that the individuals will spur government, will spur spending in a private sector, and the people will start up businesses and hire people. That's the drift that's being attempted here.
Okay. In theory, if you save a little on your taxes, you'll spend a little more. I think Representative Ryan was saying maybe that $200 you can make a new kitchen out of it or something.
Yeah, I mean, what people do, I mean, for the individual taxpayer, there will be some people that are going to be disproportionately affected by this. But I think when we look at a broad base of, 70 or 100 million tax returns, you're going to see that in that pool of people, the vast majority are going to be very modestly affected. I mean, I've talked to clients, and a couple $1,000s one way or the other, depending on the variables that a person might have. But unless you're in a huge income tax bracket with enormous, and we'll get into some of the deductions that are going to be curtailed, most people in Ohio are going to have modest change in a big picture on their tax returns.
So are we saying then, on the face of it, really not much is going to change? When you say modest...
This tax act?
Yeah.
Nothing significant.
Okay.
I mean,
Well,
we have a bunch of changes,
Okay.
and it's going to affect some people.
All right.
But a significant change is if we would say, hey, we're going to a flat tax,
Right.
we're going to a consumption tax, we're going to a sales tax,
Okay.
we're going to a system, and you and I have spoken about this, where we tax people across the board. We have an incredible amount of underground economy activities. This does not touch one bit of underground economy. It doesn't touch anything as far as illegal activities, people that are basically in business and don't properly report their income or overestimate their deductions. There's nothing in the tax bill that is addressing those issues. So we have some changes, there's no doubt about it, more changes than maybe we've had in a relatively recent number of years, and they're going to have to work through. But as far as a major change to how we do business in the United States as far as personal income taxes, I would give this low marks.
Okay. Let me ask you about one significant change, is that the corporate rate has gone down from 35 to, I think, 22 or 21%, which individual taxpayers may not think that's real fair because they're not getting 14% off of theirs. So how does that work? And that's what they call a permanent change, which I don't know that there's anything permanent in the government, whereas the individual rates are supposed to go back in 2026 or whatever. So
I have no observation.
No thoughts
other than I would
on
like
that?
to see corporations pay no tax.
All right, and tell us why.
And then we'd have a better business environment, we'd be more competitive, we'd have better expansion. So I'm pro-business paying no tax. So goods and services would probably be cheaper.
Okay.
Because they have to collect the money to pay the tax. So there's a fair number of arguments that corporate tax at zero level would be.
Are there any countries that have zero tax? I don't think there are.
I don't know if the Hong Kong, Singapore type countries have no tax or not. I cannot speak to that.
Okay. All right. Well, let's talk about some of the changing rates and deductions which are going to be there and aren't going to be there.
Sure.
And significant to the individual taxpayer. which is anyone from apparently 20,000 up to hundreds of thousands.
Hundreds of thousands.
Right.
Yeah. Well, we talked about the tax rate. That's going to be going down. A big change we're going to have in 18 is composed to
Now, when you
prior
say,
years.
okay, let me ask you just for a second. When you say the rates are going down for comparable amounts of adjusted income, is that
Virtually
is that what that
all
means?
the income tax brackets are going down. Small changes.
Okay. For the amount of income.
Right. So if say 75,000 or 100,000, each bracket will be taxed a little bit less.
They haven't changed the forms yet, though, have they? That probably won't happen until next year.
The actual tax forms probably won't come out until January of 19,
Okay.
because all the software and all of the processing people are so nervous that there'll be a last minute change in the tax law, which has happened virtually year after year after year after year. So they won't have anything for 18 until 19.
Okay. Okay, so let's talk about what is touted as the deductions which are allowed and the deductions which are going away then.
Yeah, okay, well, the first thing that is generally perceived as relatively pro-taxpayer is a combo, Mike. First of all, the standard deduction is going for married people, and that's the easiest one maybe to understand, to $24,000. And that means you don't have to itemize for medical or charity or taxes or any sort of other items that would be itemizable deductions. You get $24,000. Now there's a trade-off. The standard deduction goes up, but our personal exemptions have been eliminated. So
now, whose idea was that, and why is that supposedly a good thing in this?
I can't point my finger to any one person, but an overriding, and as we flush out some of these concepts,
Okay.
what I believe is the overall intent of a lot of this is tax simplification. By eliminating deductions for personal exemptions, it's just a whole other thing that doesn't have to be reviewed, audited, made sure that proper compliance has been done by the IRS. It's a whole step that's off the table. They don't have to worry about that.
The IRS doesn't have to
Does
worry
IRS,
about it. Okay.
exactly. And a lot of these are work savers, the concept being that the government should be more efficient, have other things to do. A lot of the nitty-gritty of looking at some of these deductions does not have to be supervised, if you will. And this is one of them, so that the standard deduction goes up. So somebody who is a married person, there's all sorts of different examples, but if you have a married couple that have not been itemizing, and there's two of them, and roughly $4,000 each, and so if you go from 12 for a married couple to 24, and you pull out the two exemptions, they're going to be a little bit ahead. The other thing that the IRS is trying to do, in my opinion, Mike, is to eventually get rid of all itemized deductions. I think this is the first step in really dramatically altering the whole way we do the income tax world. They have been raising the medical floor for medical deductions now for several years. We're going to see later is going to be some curtailment of state and local taxes. Okay, itemized.
Who's going to curtail those?
The new tax bill. We'll get into that.
Okay.
But when you look through the different items that were available for itemized deductions in prior years, that list has shrunk. The list has shrunk, and I think what we're seeing is a movement by the government to eventually get rid of all these itemized deductions, and we'll have, I'm assuming, a larger standard deduction, which would take care of all of that record keeping, compliance, review by the government, work by taxpayers, work by individuals to try to coordinate and report their deductions.
Okay, well, let me ask you this. Presently, and that'll be for this year, this standard deduction for married people, as you said, is $12,000. And I think it's $4,150 for the exemptions. Everybody would always try to have their children in December so they'd get a whole year's
tax planning,
exemption.
absolutely.
So if a family of three would be about 12,000, so there's your 24,000. So doesn't this hurt people who have more than three in the family?
Yeah.
Because they're actually losing $4,000 toward the taxes, and and then they could be bumped up into a higher bracket, maybe pay more.
Yeah, it's possible, but we haven't got all the rest of the elements to the puzzle. The child credit has been expanded to $2,000, so there's a bump there.
Tell us how that works.
Well, you basically get a dependent exemption, and there are some income levels, but people are now, instead of $1,000 per child, can have $2,000, and this is a tax credit, not a deduction. So it's really hard to, clearly somebody with 10 children would have 10 children. Yeah,
five in a family. I don't think is unusual. Three children.
Yeah,
that's what I got.
Yeah, but there's only
not children anymore.
Yeah, but you have to. About half the returns have no children. There's about about 15% have one kid, and about a little under 15, or about the same, have two. And so the returns that are filed with children are statistically, I mean, there's still a bunch, and there's certainly a lot of people that have a lot of children, but it's a statistical small number in the big picture. But clearly, it is possible that somebody with a lot of children and low income, with the loss of the personal exemption, depending how much credit they get, they could end up plus or minus. That's definitely true. There will be some people. I think the lion's share of the people are going to get benefit from this tax plan, especially people in Ohio. We can get to this tax part with respect to state and local tax.
Well,
but you'd almost have to have a software program to figure out the interrelation between the personal exemption with the standard deduction going up and the loss of the personal exemption and the increase in the child credit. So you just can't say one thing is going to be a cure-all. But it is definitely possible there will be some people under the tax bill that are not going to be winners and are going to pay a little more tax. There's
we're
no doubt
supposed to
about
all
that.
be winners. This administration says we're all going to be winners with this plan.
Not going to happen. And especially people...
Where it's not going to
happen.
Not
going to happen. No, it's not going to happen.
Especially if you have a big family, right?
And if you live in a state where you have a high state and local income tax.
Okay.
And we definitely have 5 states where that's going to be a problem: California, New York, New Jersey, Connecticut. I think Oregon is the other one.
Okay.
And those states, Mike, we're going to see there's a cap on the state and local tax of $10,000. So if somebody has large state and local taxes, they definitely are going to be impacted by the bill.
Okay, I think our discussion has inspired at least one caller. We have a call on the line. Good evening. You are on You and the Law.
Yes, my name is Clarence Jacobs. I have a question. Will the new tax law take into consideration anyone who is 65 years or older? Will they receive that additional deduction?
Okay, I think what you're referring to is under the present law, folks over 65 get a little extra, right?
Yes.
Okay. What do we know about
My
that?
understanding is there will be no add-on for folks over 65.
So that hurts seniors then.
Well, yeah. I mean, again, it depends, because he's getting $1,200 if it's a single. If say it's a married return, and we have both people over 65, they would lose 8 but they would gain 12. So they're ahead if they don't itemize.
Well, under the old law, which is the law right now, you'd get 12.
Well, 12 plus 8, you get 20.
Plus plus 8.
Yes.
And then I think there was an extra, the caller can remind me, I think it's 3,000 or 4,000. So you might get an extra 1,000 off, is what you're saying.
It's
Yeah, that's about right.
Is that right, Mr. Jacobs?
Yeah, it works out to about $1,200.
Okay.
yeah. Okay, so under the new law, you would lose that, but you'd get an extra 12,000 as a standard deduction.
I see. Okay, so that deduction would be eliminated then under the new.
That's correct.
Okay. All right. Well, thank you.
Thank you for
Good
calling.
luck.
All right. Let me take a short break here. We're about halfway into the program, and I promised our sponsor, the Dayton Bar Association, would talk a little bit about them. We are sponsored by the Dayton Bar Association and for our show, and have been for a number of years. Since 1883, the Bar Association has been in effect, and there are community services that we provide to citizens of the valley here, the Miami Valley, and I'll tell you what some of them are. And I'll tell you who our executive director is, and I hope she's watching, Sally Dunker, who has been instrumental in helping us produce our show. We have a lawyer referral service. If you don't have a lawyer, if you call the Bar Association at 222-6102, they will try to find you an attorney who is an expert and familiar with your situation. The website is daybar.org. We have a notary public service where you can become a notary. You have to apply and test, and you have to pass the test. We have a pretty good pass rate, I think. So that would be good. And a Wills for Heroes program, where member volunteer attorneys create wills and estate documents free of charge for emergency first responders, police, and fire and EMT. We also have a speakers bureau. If you need a speaker for your group, contact them, and they will provide you with what you need. Some excellent speakers in our association, and the number is 222-7902. Okay, so you're watching You and the Law, 223-5311. We're audience participation, and you can call in tonight. We're live and in color, and we have Mr. Chris Cowan, who is an expert on tax and tax problems, and he's been illuminating us for the first half hour of the show. So if you do have a question, now is a good time to call in. So we were on deductions.
We're on deductions. We talked about brackets, Mike,
Right.
and the standard deduction, and we talked a little bit about the child tax credit.
Right, okay.
Charitable contributions, we're getting a little more relief for those who are charitably inclined.
Well, that's a good idea, isn't it? I mean, I'm thinking that people, unless they get a little break for their good-heartedness, may not contribute at all. And if you don't get some relief, as you say, in the form of a deduction, maybe you wouldn't do it at all.
Yeah, there was an exemption or a cap, Mike, on what you could do with charitable deductions. It was basically 50% of your income. That has been up, not a lot, but to 60. But I think if you're looking for a planning point here, I think we're going to see more of, as we lose some of these deductions for state and local taxes, as we lose some of these deductions that we're going to get to for certain miscellaneous items. I think we're going to see more bunching, Mike. I think we're going to see people think, well, gee whiz, this $24,000 for a married couple, the scenario we've been using, I've been giving, let's just say, $5,000 or $10,000 to the church or whatever.
Okay.
Well, that may not be enough to get you over the standard deduction amount.
Right.
So people might say, you know what, I'll bunch them up. I won't give this year, but maybe I'll double up the next year.
Okay.
So I think we're going to see a lot more people not on the smaller gifting, but on the larger gifting, they're going to bunch. They're going to bunch up because they don't want, obviously people wish to make gifts, but it doesn't, it's kind of nice if you get a tax break too by making your gift. What's wrong with that? It's a win-win. So I think we're going to see more and more planning in this arena on gift giving.
Okay. Tell us some of the things that are, okay, you can still itemize, but only certain things.
That's correct.
Tell us about the medical expense deduction and how that applies. And the last call was, a caller was talking about seniors and whether that percentage is still available.
Well, it's the same. We have a couple of hurdles with the medical things. First of all, we have to bunch them all up, and then we're going to have to get over 7.5% of our adjusted gross income. So most people that have not extraordinary health problems and somewhat decent insurance coverage never get to itemize the medical, because the 7% of your adjusted gross income is the ceiling you have to get over. So medical deductions are basically the same. You're going to have to get over the floor before they become deductible.
Which is what, 7.5%?
7.5%.
Okay. And that's of your adjusted
of your adjusted gross income.
And then you can only get the amount that's over.
It's over. Right? So if you're for an easy number, if your adjusted gross income would happen to be $100,000, 7.5% is $7,500, and you would get no deductions until you went over the $7,500 amount.
Okay.
That's very close to what we have going on in current law.
Okay. One of the old staples of deductions, of course, was mortgage interest. And I think the original plan for that was so people would buy houses.
Yeah.
And it helped banks too, I guess, that was loaning. If you're not buying a house, you're not borrowing anything. Nobody's pays cash. I wouldn't say nobody, but hardly anybody. So is that still in, or is that out, or is it modified?
Modified. We have a modified. You can buy any house you wish, but IRS for new homes, $750,000 is basically the amount you're capped out as far as a mortgage interest deduction. Mortgage interest is what we're talking about. So if you're under, no problem. In Dayton, if you buy a $400,000 house or a $500,000 house, $750,000 house, no problem. If you go over the $750,000, the interest on the excess, not deductible.
Okay, so that pertains to the value of the house, not to the amount you pay?
The mortgage.
Right, the mortgage.
The mortgage, that's correct.
Right, the mortgage interest.
Right, you could buy a $2 million house, but maybe you only need a $750,000 mortgage. So it's the size of the mortgage.
Okay. Right, okay. So up to that amount you can
deduct
if you want to deduct. And again, as we said before, you have to exceed the standard deduction threshold
before it will get you any benefit.
I found this interesting. There's been a change in the treatment of alimony payments and reception, and I think a lot of folks would be interested to hear that, whose marriage may not be as successful as when it started out. So how is that working now?
Mike, I think we're going to hear more about this because...
Okay, so I'm right.
You're right, you're spot on. This is, 18 is the last year we sort of have the old rules being if it qualifies for alimony and not child support, then the person who is paying the alimony gets a deduction. The person who is receiving the alimony picks up the income. So it's supposed to be a wash.
Well,
the person who pays
sort of makes sense, doesn't it?
Sort of makes sense.
Yeah, okay.
The spouse that's paying gets a deduction, and the spouse who's receiving picks up the money and pays income tax on it.
Right.
Okay.
Okay.
That law is going to work through this year.
Okay.
Marriages that are ended, Mike, in 19 and in future years, it's going to be a non-transaction. The person paying does not get an income tax deduction, and sauce for the goose, sauce for the gander. The person who's receiving isn't going to pay income tax. This is another area in my opinion, where IRS has had a lot of troubles matching this up. Somebody takes a big deduction, somebody forgets to report the income. They're all the time going back and forth, trying to figure out, are they matching? Is there something out of whack with these numbers? It's a real common problem. And so this is an area where I think the government and the IRS are looking for a way just to walk away from these transactions, not spend resources and time trying to balance the deductions with the income. And that's a similar sort of thing we're seeing in some of these changes.
Okay. Tell me if I'm wrong. It sounds like the person who is receiving the alimony, if they don't have to count it as income, I'm not saying it's free money, but it's theirs, whereas the person who is giving it no longer can take it off.
Take a deduction.
So sounds like they're kind of getting hurt.
Yes.
Doesn't sound like a wash.
How
is that a wash?
Oh, yeah. I'm
What's he gonna say?
Sure. This is absolutely, the IRS has to try to figure out the balancing of the money, but it's only a wash if the payer and the receiver are in the same income tax bracket. It's totally possible that
it's a wash now, but it wouldn't be a wash
it's only
later.
It's only a wash now if they're in the same tax brackets. In other words, if the payer is in, say, it's 39, but let's just make it easy, a 40% tax bracket, and the payer pays out $10,000, they get a deduction, if you will, for a net of $4.
Okay.
$4. Okay, hang on. And if the person who receives it is in a no tax bracket, it's possible, but say they're in a no, they make it the worst case, then they're getting money and paying no tax. So the IRS, you'd have to look at a large sample, but my guess is, if you want me to guess, that people that are paying are generally in the higher bracket than the people who are receiving alimony, as a general statement. So this would be a revenue addition to the plan where the government is most likely going to pick up more dollars and doing less work, because they don't have to match this stuff up.
So when you're saying it's a wash for the IRS. It's not a wash for the people. One of them is suddenly paying and not getting any deduction for it. The other one is getting and not paying any income.
Well, I'm talking about just gross dollars.
Yeah, gross dollars.
Gross dollars. But this is clearly a IRS revenue collector.
Okay, good for one person, not good for the other.
Yeah, somebody's going to win and somebody's going to lose on this, and the government's a double winner, in my opinion, because it takes away a whole bunch of work they don't like doing, and number two, most likely, the government's going to get more money.
Do you think that this will inspire more fights for alimony?
There'll be no fight for alimony. They'll call it just property division or something.
Okay.
I do no divorce work, but I think it's just going to be, my guess is it's going to be a saver for labor for the attorneys, because they're all trying to figure out what are the tax effects of doing this. And now I think it's going to be simpler, truthfully, on the DR level. You're going to need a DR fellow to come in, but I think it's going to take some hassle out, because now they can just divide up and try to figure out what an income stream makes sense.
We do need a show about that.
And strip out the tax problems, because the tax problems are hard on this.
Okay. All right. Well, we'll leave that for now.
But I'm guessing it's a simplicity thing.
I would think if I was getting alimony, I'd want to get more and more if it wasn't going to be taxed.
Yeah.
And I wouldn't want to give alimony because
you're not getting a deduction.
No deduction.
No deduction.
It's just like having your money fly out the window.
Well, it'd be more like child support in treatment.
Yes.
Absolutely.
Yes. Okay. Let me ask you something which this is going to affect the government, the IRS. This plan, the Republicans tried to get rid of what they call Obamacare. They've called it a disaster, but more and more people keep signing up for it. And I'm not asking you to sign on whether it is or isn't. But being unable to do that, part of this tax plan is eliminating what was called the ACA individual mandate, where if you weren't covered by tax, you'd have to pay the government.
Not covered by insurance.
Not right. That's what I meant. No,
Not covered by insurance, you pay a...
If you can't show an insurance policy,
Yes, sir.
then you should pay the government some money. Okay. Now, aren't we going to get less taxation into the government because of that? Isn't that going to hurt the IRS and the government? And isn't it going to hurt the ACA?
I really don't know about the ACA.
Okay.
But the generation of revenue from that is pretty modest. I think...
But it'll become more if people think they're just betting against themselves needing any insurance and saving their, what's the mandate now, $400 or $200?
Yeah, something like that. It's relatively...
It's some amount, which actually, if you didn't really, you ought to just pay it probably, but a lot of folks don't want to. So
Yeah, I can't address that question. That's, I have almost all my clients, I think I had 2 people, Mike, in the last couple years who weren't under insurance coverage, and there was some mandate tax.
Okay.
It was minor amounts, if I recall, $400 to $500. So I don't have a real good practical feel for that. But clearly, if the mandate tax isn't being collected, there's not revenue, then there's all the compliance piece that goes with it. So there is some savings there, but I do think that some people were buying insurance because they didn't want to pay an additional tax to the government. So
well, and it was more responsible that they were suddenly insuring their family rather than just
yeah, no argument.
taking a chance of not getting sick, which if you have that family of 5, somebody's going to get sick sometime.
Somebody's going to get sick, yeah.
Yeah, so, okay. We haven't talked about the state and local taxes as a deduction and how the new federal tax plan is going to affect those. So
There's a big change there, Mike.
Okay.
State and local taxes are going to be capped out, starting this year, 18, for married people, $10,000.
that means if you pay state and local aggregate of $10,000, you could, in theory, deduct them on your Schedule A.
You couldn't this year. Well, for 17 taxes, no limits.
No limit, right.
There is an ultimate minimum tax, but we don't need to get into that for
Okay.
super high taxpayers. But starting this year, Mike, 18 going forward, your state, your local, your real estate taxes, if you're paying property taxes, you combine all those up. If you're under 10,000, no change. You'll be able to deduct those, no problem. If you're over,
And you still have to exceed the 24.
right,
for it
you'll
to
take
apply.
your taxes and add them in with your contributions, your medical expenses, to see if you go over the 24,000.
Okay.
Okie doke. If you're over, if your state, local, property, real estate taxes are over the 10, you'll be capped 18 and going forward to $10,000.
Okay, now there's already been talk about states that have higher rates, New York, California, and a couple others. Their citizens are going to get hit harder than others.
I don't think there's any doubt about it. Ohio, our taxes have been going not down a lot, but our state taxes have been going down, and our brackets are phenomenally lower than, say, an Illinois or a California or a New York state.
Do you think that something like that is going to inspire constitutional challenges?
No, but I think people are moving from Illinois to Ohio, and I've already seen
Well,
that.
we're happy to have them,
And,
I guess,
and
aren't
I'm
we?
telling you, I'm told that 4 million people moved from California to Texas over the last decade. So people are going to definitely move. I think New Jersey and New York are going to be under increased pressure. Illinois is another state that's under increased pressure. So I think we're going to see people move. I really do. I have actually had 2 clients come from Illinois that I've managed to come in contact with this last year or so who've left Illinois because of tax burden. And also, this is not on our issue, but also fear of losing their pensions. They were both state employees, and they were able to work in a related industry and move their pensions out of Illinois. And so...
That's important, isn't it?
Well, we're off topic a little bit.
Yeah.
We hear in the news that Illinois has serious problems with funding their pension plans and high tax burden. And this is an unusual couple. They're both able to move and get comparable type jobs in our area. But they told me that their main reason was pulling these pensions out. So, we see cities going bankrupt and things like that. It does make people a little nervous.
Okay, we've got about 10 minutes, and we're going to cover a few more things unless we get a call or two. And for you viewers out there, you still have time to call in if you want. 223-5311, there's the banner right below me there. And we're talking about taxes with Chris Cowan, who, if you didn't realize before tonight, you do now. He's an expert in taxes.
Mike, I want to say one other thing. We talked only briefly about miscellaneous deductions. They're gone in 1918 and going forward. Union dues, job-related expenses, tax preparation fees, investment fees, a lot of people paying private money people to manage their money. Those fees are all gone. So that whole block at the bottom of the miscellaneous deductions, all erased. Now, those also were subject, as you know, to the 2% floor ceiling, where you had to get over your adjusted gross income, and lots of people were boxed out because of that. But there were many people that were over the 2% that got to add those in as part of their itemized deductions. So that whole layer of compliance and record keeping is now not going to be going forward.
Do we need to discuss a little bit about payroll withholding? Is there?
We don't. That'll all be taken care of.
Let's talk about estate and gift tax. For a long time, the party that passed this tax plan wanted to do away with estate tax federally. Anyway, Ohio has done away with estate tax. What does this bill do in regard to estate and gift tax?
It's actually kind of amazing, Mike. If you would have bet me or asked me to wager with you in the 80s, would we be in an environment in Ohio where we would have no death tax, and the old Ohio death tax for a single person was basically over $300,000, you paid 7%, rough numbers. And there was $1 million exemption for a single person, and the tax roughly 50%, over $1 million. Now, we have no Ohio death tax, zero. It doesn't matter if you're a regular person or if you're a Mr. Gates living in Ohio with billions of dollars, no Ohio death tax. And the old the old million exemption was increased to 5 million, basically, which was last year, 5 million plus. And now we're at 11 million for a single person each. So a married couple has basically $22 million of exemption. That's of net value, and it can be transported from husband to wife at death. So it is phenomenally pro-taxpayer. $11 million makes probably just, there may be only maybe a couple of thousand federal death tax returns filed throughout the U.S. in a year.
So how does that affect the gift tax? I think we were up to $15,000 a person.
Oh yeah.
How does that going to work now?
Thank you. The gift tax and estate tax are actually unified.
Right.
So you can actually make, if you wanted, Mike, if you wish to make me an $11 million gift today, you could do so.
Okay.
You could. You could give Chris $11 million. You would have used up your unified gift and lifetime exemption. And then whatever property you would have left after that million would be taxed if you were single, because you have used your gift tax exemption before you died and not part of your estate. You can also, in addition to that, you can give $15,000 to any person you wish in the U.S., friends, neighbors, people at church, co-workers, and it's totally income tax, gift and estate tax free, and it's non-reportable. So
Up to 15.
person per year.
$1 over that, you
You're
have to
supposed-
file.
you're supposed to.
I can't remember the number of the.
709.
709.
709, yes, sir.
Okay. So we can go out and make as much money as we want now, and maybe not as much as we want, up to 22 million, the same as a utility infielder for the Reds.
Right.
So
The fifth outfielder.
the fifth outfielder.
Yeah.
Okay.
I mean, it's incredible. I mean, it's really hard to imagine that in a relatively short period of time, we've gone to virtually no taxation of estates for almost everyone in Ohio. It is really very pro-taxpayer.
Okay, so is this tax plan, I know it's just getting started, and it's had a lot of discussion both ways, is who's getting the benefit and who's robbing who and who's not. In your opinion, having done this in your accounting background, is it going to work, or are we going to wind up raising taxes again? I mean, you can only lower them so much, I guess.
Yeah, I mean,
Or am I putting you on the spot?
No, this is fine. This tax plan will work because we only spent an hour and we haven't really peeled the onion back in all the little spots. But this is the high water mark of the most major changes. People can pick this up in a little bit of time, and after a year or two, they'll have a sense on how this all...
How long do you think our viewers would watch us if we really went into depth on every single thing?
About 7 minutes.
7? Well, we only have 4 left here. So.
And so, yeah, this will work because the accountants are going to understand it. The people who are handling these transactions will have it. Next year may be a couple surprises, the 18 tax filing season. But I think, truthfully, is the majority of the people, when they really look at all the pieces, when all the pieces fit together, the lion's share of the people are going to be modestly impacted one way or the other. And the only people who are going to be, in my opinion, grossly or disproportionately impacted are going to be some high income level people who have really large state and local taxes.
And a lot of kids.
And somebody that has a lot of kids, but that's not that many taxpayers. There's no kids in our street, for example. There's no kids. I have a street with no kids. It's a random thing,
Yeah,
but I'm telling you,
right.
if you look at the lion's share of people, they're going to be very modestly impacted.
We'll probably hear from the ones who get hit the hardest. They'll probably call their congressman the most, do you think?
I'll say yeah. Yeah.
Okay. Couple of minutes left. Give our taxpayers some tips of do's and not
Okay.
to do's.
Oh yeah, sure, I'd be happy to. Number one, no one goes to jail for filing their taxes and not paying. Remember Al Capone, he went to jail because he did not properly file his returns under reported income.
File them by the 15th.
Right, file your tax return, number one. Number two, if you have taxes to pay, you should pay some, right? But definitely getting the return prepared is number one thing to do.
Okay. Some things you shouldn't do.
The biggest mistakes people make are silly mistakes.
Check your math, right?
Check your math. Get the Social Security number right. Get the all the names and addresses right. Truthfully, a little TurboTax will remedy a lot of the problems because it'll clean all that up and won't process it without it. We should talk a little bit about IRS fraudulent type representations, Mike. Believe it or not, my wife gets called at home saying that we haven't paid our taxes and somebody's going to jail. The scammers are out there. We have phishing stuff literally every week at our office where there's representations that they're representing the government or somebody else. Please give us information.
The IRS doesn't call you on the phone.
The IRS will not do that. The IRS is going to write you. It is possible for a criminal investigation person to come out, but you will know it if that happens.
Yeah, they write to you first.
They will write to you and they will show up. So do not fall for any of the phishing scams. They're really bad. I've been called at work. My wife's been called. Most recently, Mike, a neighbor actually had some sort of a note in her door that the IRS was there, and if she didn't pay a certain amount by a certain time, she was going to go to jail. She called the police, and the cunning and the effort and actually the skill, the phishing techniques are getting more and more sophisticated, I think, all the time.
Yeah.
So beware.
Okay, good. Checking with the floor director. Okay, we're out of time. It's been great having you here. We're going to bring you back next year and see if all these predictions you made, you didn't make many, but see how all this pans out. So thank you for watching, everybody. You've been watching You and the Law here on DATV. I want to thank all the volunteers behind the scenes who have made the program possible as usual. Again, thanking Chris Cowan for taking time out of his busy day and a busy tax season. And a shout out to Lily, Katie, and Everett. I'm your producer and host. Thank you for watching. We'll see you again next time on You and the Law. Good night.